Good afternoon. This is Robert Karras of our Karras Asset Management and Planning in Independence, Ohio. I'm here today to discuss several aspects of financial planning. We have created a series of brief videos in an effort to help individuals understand the basics of financial planning and some of the pieces involved. In today's video, we will discuss asset allocation and why and how it is important in your overall investment plan. Most of what we discuss is geared to be a summary of the overall asset allocation process. Of course, we suggest working with an investment professional to design an allocation program that is right for you. We have spoken in our previous videos on the difference between investing for speculation or gambling versus savings as a means to methodically invest for the long term. We have come to the conclusion that investing is a combination of both. Done properly, investing is a carefully planned approach to managing and accumulating money for the long term. The first step in any investment plan is to identify your goals. In other words, what are we trying to accomplish? Are we looking to accumulate assets for retirement, college, or perhaps a short-term horizon such as a vacation or a new car? Once you identify your goal, selection of proper assets would be important to match your investment time horizon. The reason we start to identify goals and time horizons is to help manage risk as well as start to pick the assets that will be involved in our financial picture. One of the items we utilize is a risk tolerance questionnaire. This allows us to understand a client's level of comfort when it comes to risk. We all understand with investments you can't completely avoid risk, but you can help manage it. This risk factor we uncover helps in deciding which individual investments are right for you. Would it be aggressive, moderate, or conservative? One of the greatest investment fundamentals is the relationship between risks and return. We've assembled various investments and laddered them from safest to most risky. If someone may be very risk averse, they should stick toward the bottom of our risk ladder. Of course, the extreme opposite would be on the top with options and futures. No one asset is right for everyone, and since there is a risk-return trade-off, we highly suggest your plan be matched to the level of risk you could assume. Listed here are several types of commonly held forms of investments, ranging from the safer cash and cash alternatives to bonds, stocks, and other investments in mutual funds. Many people mistakenly think 401k plans and IRAs are an investment. These are not, in fact, investments. They are tax-advantaged vehicles that hold individual investments. It is widely known that any portfolio should include a mix of investments. That means that all portfolios should contain investments with varying levels of risk to minimize exposure. Many investors make the mistake of putting all their eggs in one basket. An example would be putting all of your investment dollars into one stock. Sure, if that stock goes through the roof, you make a fortune. On the other hand, if that stock tanks, you may lose all of your value. Diversifying your investments over several asset classes will help reduce your risk by losing your entire investments. Keep in mind that diversification does not insure against a profit or guarantee against a loss. It is, however, a better way to manage your overall risk. Asset allocation is one of the first steps in creating a diversified portfolio. Asset allocation is the concept of deciding how much of your investment dollars should be allocated among broad investment classes, such as stocks, bonds, and cash equivalents. The underlying principle is that different asset classes have shown different rates of return over time. Diversifying your investments over different asset classes may help you lower your overall volatility of your portfolio. So the question is, how do you choose the right mix for you? Well, there are a number of resources available that we utilize, including a number of variables such as your age, time frames, and personal situation, as well as your tolerance for risk and your outlook on the economy. These are just a few of the reasons it may make sense to work with a financial professional to help you gauge your risk and match it to an allocation that would increase your chances of financial success. The next several slides provide some asset allocation models, and every individual situation is unique. Nevertheless, in general, conservative asset allocation models will invest heavily in bonds and cash alternatives with the primary goal of preserving principal. In comparison, a moderate asset allocation model will attempt to balance income and growth by allocating significant investment dollars to both stocks and bonds. Finally, an aggressive asset allocation model will tend to concentrate heavily on stocks, focusing on potential growth for the future. As you can see, there is much to consider when investing. If you don't have the time, desire, confidence, or inclination to develop and monitor your own plan, you may benefit from a financial professional. We help determine your goals, timeframes, risk tolerance, and create an asset allocation plan to help map out your future. I want to thank you for your time today, and if you have any questions, I would welcome the opportunity to meet individually with you and address any specific questions or concerns you might have. This is Robert Karras of our Karras Asset Management and Planning in Independence, Ohio, wishing you a good day.